Usually when we look at the business world around mid-June, there's this familiar, like almost frantic ritual that takes over.
Oh, yeah. The corporate trolley dash.
Exactly. I mean, business owners and executives take this hard look at their balance sheets, realize they have a looming tax liability, and suddenly they're just, well, bulk buying things they don't actually need.
Right, like stacks of ergonomic office chairs that just sit in boxes until August.
Yeah, or upgrading an entire fleet of laptops that, probably had another perfectly good 2 years left on them.
It is the classic end of financial year panic buy. And I mean, if you look at the behavioral economics behind it, it makes sense.
I'll see.
Well, a physical laptop is tangible, right? The purchase is immediate, and it provides this incredibly comforting illusion that you are being highly strategic with your remaining capital. But it's largely just an illusion.
An expensive illusion at that,
Yeah.
because you can point at that shiny new commercial printer and tell your accountant, hey, there's my tax deduction.
Yeah.
But then you walk out onto the floor. You look at what is actually holding the business back, the real daily operational bottlenecks, and it becomes painfully obvious that a new monitor isn't going to fix a broken, disconnected workflow.
No, it absolutely will not.
Today, we are looking at a financial landscape that is about to shift so drastically that relying on this usual hardware dash is going to leave a significant portion of companies at a severe disadvantage. Welcome to today's Deep Dive. I'm Lex.
And I'm Vera from the C9 Podcast Show.
A very warm welcome to all the followers of the C9 Podcast and Business page tuning in. I want to be explicitly clear right out of the gate here. We are speaking directly to you, the Australia business owners and C-level executives.
Yes.
The mission for this deep dive is, quite frankly, critical. Every single year, you have to scramble to figure out where to allocate capital before the financial year closes. But the stack of tax legislation and economic forecasts we're looking at today proves that EOFY 2026 is a historically unique window.
It really is. It's a definitive legislated cutoff.
Right.
We are exploring a massive, widely unknown tax advantage, specifically for bespoke technology, and it ends entirely at midnight on the 30th of June, 2026.
Wow. Midnight.
Exactly. And as we'll explain by breaking down these ATO rulings, the time to actually act on this is measured in weeks, not months.
Okay, let's unpack this immediately, because we really have to establish the baseline of why 2026 is fundamentally different from, any year we've seen recently.
Yeah, absolutely.
So if we look at the current state of play, the instant asset write-off, what accountants call the IAWO, sits at a $20,000 threshold.
Currently, yes.
But at midnight, on June 30, 2026, it doesn't just dip slightly. It plummets by 95% down to just $1,000.
It's a massive drop.
It sounds slightly dramatic, but it's literally a financial Cinderella story. You're at the ball, the music is playing, but at the stroke of midnight, that $20,000 carriage turns into a $1,000 pumpkin.
That is a very accurate way to put it.
And if you miss that window, you are stranded. There is no next year for this level of deduction.
No, there isn't. The legislation backing that up is the Treasury Laws Amendment 2025. This isn't a rumor or like a proposed bill. It is locked in.
Right.
If we connect this to the bigger picture, this represents a fundamental permanent shift in the economics of business investment in Australia.
So what does that actually look like on paper?
Well, let's break down the actual financial reality of that. If you make a $20,000 capital investment before that June 30 deadline, you yield a $5,000 to $6,000 immediate tax deduction in your FY26 return, assuming standard corporate tax rates.
Right, so your net cost of doing business drops the moment you file.
Exactly.
But let me stop you there, because the natural pushback from a business owner is, well, what if I just don't have the bandwidth right now? What is the actual penalty if I just wait and make that exact same investment on, say, July 1st?
The penalty is entirely in your cash flow and your delayed return on investment.
Okay.
If you wait until the morning of July 1st, that exact same $20,000 investment falls under the new rules. You no longer get that immediate $5 or $6 grand injected back into your operations.
Ah, I see. So where does the deduction go?
Instead, the asset enters a small business depreciation pool. You might get around $750 back in year one, and the remainder of that tax benefit is trickled out to you over 4 to 5 years.
Oh, wow. Over 5 years.
Yeah. From a strategic standpoint, locking up your capital for half a decade when you could have had the liquidity immediately is just, well, a terrible position to put your balance sheet in.
Which brings us to the most crucial pivot of this whole discussion. Because now that you as a business owner or a CEO understand the severity of this $20,000 cliff, the immediate question is, what should you actually buy to leverage it?
Exactly, and the answers might surprise people.
Right, because if we look at the data on SME spending, most owners, and frankly a massive percentage of traditional accountants, they immediately default to physical hardware.
Yeah, they want a new work truck. They want the top-tier coffee machine for the break room. They want tangible goods. They want the things that feel like traditional assets because they take up physical space.
Right. But looking at the ATO guidelines we've pulled for this deep dive,
Yeah.
that mindset is actually blinding businesses to their most valuable potential asset.
It really is.
Here is the massive knowledge gap custom software, bespoke apps, system integrations, and database development all explicitly qualify as ATO-eligible depreciating assets.
Which is huge.
We are talking about commissioning your own custom project management systems, secure client portals, automated reporting dashboards, or API integrations that finally get Xero, Shopify, and your CRM talking to each other.
Which is a complete revelation for many executives who still view software strictly as an ongoing monthly operating expense.
I do have to play devil's advocate here, though, because I can hear accountants listening to this and just screaming at their dashboards. Wait, an asset is usually a tractor or commercial oven or a massive server, rack something heavy that you can accidentally drop on your foot.
Right, the physical test.
Yeah. How on earth can invisible code floating in the cloud count as a depreciating capital asset in the eyes of the ATO? It feels completely counterintuitive.
It is a valid pushback, and it comes down to a misunderstanding of how the Australian Taxation Office classifies computer software under Division 40 of the Income Tax Assessment Act 1997.
Okay, so what does Division 40 actually say?
Under their strict guidelines, purpose-built business software has an effective life determination of 4 to 5 years. The ATO views it as an in-house depreciating asset that was built specifically for your business operations to generate income.
Oh, interesting.
So while you cannot drop a line of code on your foot financially, it functions exactly like a piece of heavy machinery bolted to your factory floor. It produces quantifiable value over time.
That makes perfect sense when you frame it like that.
Right. And because it is legally classified this way, the instant asset write-off allows you to bypass that grueling 4 to 5 year depreciation schedule and claim the full, immediate deduction right now, provided the total cost is under that $20,000 threshold.
Okay, here's where it gets really interesting. Once you accept the reality that custom software is a legitimate tax-deductible asset, you have to take a hard look at the alternative.
Yes, the current reality for most.
We need to look at how businesses are currently paying for their tech stack. Right now, reading through these industry reports, the vast majority of businesses are trapped in what we call the SaaS trap, software as a service.
Oh, the SaaS trap. It's everywhere.
You are bleeding capital monthly on generic subscriptions. To put a visual to it, paying for SaaS is like renting an apartment where the landlord keeps raising the rent every single year. The floor plan doesn't quite fit your family, and they arbitrarily paint the walls a color you absolutely hate.
That's a great analogy.
Custom software, on the other hand, is like taking the time to build a house perfectly architected for how your family actually lives, and the best part is, you own it outright.
We should look at the balanced perspective here, though, because there is a reason businesses fall into the SaaS trap in the first place.
Sure.
SaaS is incredibly seductive. It has a low barrier to entry. You can deploy it in an afternoon, and paying, $49 a month feels like a negligible expense.
Oh, it flies under the radar.
But what's fascinating here is the sheer scale of the operational bleed this causes over time. We aren't just talking about annoying credit card charges. We have a report here from Deloitte Access Economics that highlights a staggering $109 billion lost annually in Australian productivity.
$109 billion.
Yes. They found that the average employee loses 5.3 hours every single week just to inefficient processes and manual workarounds.
5.3 hours a week per employee. Let's really drill down into the mechanics of that, because it's not just people staring at the wall. This is what the industry calls the swivel chair integration.
Oh, yes. The swivel chair.
It's an administrator sitting at a desk with 2 monitors. They're manually downloading a massive CSV file out of a generic inventory app, opening it in Excel to manually clean up the formatting, and then painstakingly uploading it into Xero accounting.
And praying it works.
Exactly. And if there's one formatting error the whole upload rejects and they have to start over, that is where those 5 hours go.
And that is a direct result of relying on generic tools that were never built to speak to each other. Gartner research backs up the devastating financial cost of this.
What did Gartner find?
They found that the average Aussie SME spends between $18,000 and $54,000 annually on SaaS subscriptions.
Wow.
If we project that out over a standard 5-year period, that so-called cheap SaaS trap ends up costing a business anywhere from $90,000 to $270,000.
That is sick.
And the most painful part, at the end of those 5 years, you have zero equity.
Nothing to show for it, but a massive stack of digital receipts and the promise of a price hike next year.
Precisely.
But if you take $20,000 and invest it in custom software before this EOFY 2026 deadline, the underlying math of your business completely flips. You get the immediate tax deduction of $5 to $6 grand to help fund it.
Yes.
Furthermore, you have zero ongoing monthly license fees. There is absolutely no vendor lock-in where a third party is holding your customer data hostage on their servers, and you retain 100% full intellectual property ownership of the code.
It fundamentally transforms a persistent, draining operational expense into a permanent capital asset on your balance sheet. This is no longer just an IT conversation, right? It is a critical strategic imperative.
Right.
It's a business strategy problem that compounds in severity every single year you ignore it. We pulled data from McKinsey that illustrates this beautifully.
What did McKinsey say?
They show that when companies implement custom operational software designed specifically for their workflows, they see a 47% reduction in time spent on manual tasks.
47%.
Yeah, alongside a 28% increase in the speed of executive decision-making.
Okay, looking at the Deloitte and McKinsey numbers, the return on investment is undeniable. It is an absolute slam dunk. But, and this is a massive operational hurdle we really need to get into, there is a catch.
Yes, there is always a catch.
If you want to successfully claim this deduction, the ATO has a very strict, unbending rule. The asset must be installed and ready for use before midnight on June 30, 2026.
That phrasing cannot be glossed over. Installed and ready for use.
So if I sign a check on June 29th for a massive software build, I mean, let's push on the exact mechanics of that. Let's say I'm a business owner. I sign a contract on June 29th for a massive $20,000 custom software build. I write the check, the funds leave my account, and I have a paid invoice in my hand. Are you telling me the ATO is going to reject that write-off?
They will absolutely reject it for the FY26 financial year.
Unbelievable.
If we look at ATO taxation ruling TR 2231, it explicitly states that merely paying the invoice or incurring the liability does not qualify you for the immediate deduction.
Okay.
The software cannot just be an idea. Furthermore, to clarify a highly technical point, it cannot just be sitting in a staging environment.
Meaning what, exactly? Let's explain that for the non-technical folks.
Meaning it cannot just be sitting on a developer's private test server where they are ironing out bugs. It cannot be in closed beta testing. To satisfy the ATO, it needs to be fully deployed to your live production environment. Your staff must have logins, they must be trained, and the software must be genuinely capable of producing the income or efficiencies it was designed for.
It has to be a living, breathing part of your daily business operations before midnight on June 30th.
Yes, and that operational reality is exactly why the critical path timeline here is so urgent.
Yeah.
You cannot wake up in mid-June, realize you need tax relief, and decide to build custom software.
Yep.
For a bespoke system to be properly scoped, developed, rigorously tested, and successfully deployed by June 30, the initial discovery calls and project proposals must be finalized by the 15th of May, 2026.
Mid-May. That's fast.
Every single day that ticks by between now and mid-May dramatically reduces the testing capacity and exponentially increases the delivery risk of the project.
Looking through our research stack at the companies who are actually successfully facilitating this specific transition for businesses, one developer that continuously stands out is C9.
Yeah, they've really optimized for this.
And what's fascinating is that C9 has proactively structured their entire delivery model around this exact high-pressure window. They commit to a 48-hour proposal turnaround for any inquiries made before that mid-May cutoff.
That's incredibly fast for custom software scoping.
Right. They don't give you vague estimates. They give you confirmed deployment dates in writing before you sign a single document. And crucially, they provide honest feasibility assessment.
Which is what you want.
Yeah, if your project is too complex to realistically deploy before the deadline, they will tell you upfront, rather than stringing you along. Plus, they hand over all the IAWO-ready documentation that your accountant needs to definitively prove to the ATO that the system was installed and ready for use.
That level of transparency is vital because, as we've established, the ATO's timeline is absolute. There is no gray area.
So let's take this from high-level tax theory down to the actual real-world proof. How does this strategy actually play out when an Aussie business pulls the trigger?
We have some great examples of this.
We have a stack of case studies here. Let's start with a trade services company down in Melbourne. According to the notes, they were completely drowning in spreadsheets. We were talking whiteboards with sticky notes falling off, manual quoting, disjointed scheduling, and just a nightmare invoicing process.
Sounds chaotic.
It was. They commissioned an $18,500 custom job management system from C9. This single bespoke system replaced their entire spreadsheet chaos. It saved them 12 administrative hours every single week, and because they could finally cancel their patchwork of generic subscriptions, they reduced their ongoing SaaS costs by $4,200 annually.
And the brilliant part is, because they ensured it was fully deployed in late June, they claim that entire $18,500 build under the instant asset write-off.
It's a double win.
Let's look at another one from the stack, a professional services firm in Sydney. Their bottleneck was client communication.
Oh.
They were losing hours every week to clients sending just following up emails and requesting manual reports. So they engaged C9 to architect a custom client portal for $16,800.
Nice. Well under the threshold.
Exactly. Not only did they secure the full immediate tax deduction, but they reported a 23% increase in client satisfaction scores because their clients finally had autonomous, real-time visibility into their own projects.
Or look at this Brisbane retail business. They were dealing with the nightmare of overselling inventory because their web store didn't talk to their warehouse.
Oh, that's the worst.
Yeah. They spent $14,200 with C9 to build a custom API integration connecting their Shopify store, Xero accounting, and their warehouse inventory system.
That's a smart use of funds.
That one targeted integration completely eliminated 8 hours a week of manual swivel chair stock reconciliation. So, what does this all mean when we step back? It means these aren't just clever end-of-year tax hacks.
No, not at all.
These are massive, permanent operational upgrades. These specific companies now possess an unfair compounding advantage over their competitors who are still paying employees to manually type data into expensive, generic software.
This raises an important question, though, very practical. What happens if a business executive listens to this, looks at their deeply complex operations, and realizes they need a much larger scope? What if the custom solution required to actually fix their bottleneck costs $25,000 or $30,000, putting it over the $20,000 threshold?
That is a fantastic point. Does the whole strategy just fall apart? Do they get disqualified from the write-off entirely?
Not necessarily, and this is exactly where strategic structuring with your accountant and a highly experienced developer like C9 becomes invaluable.
So what are the options?
You have several viable avenues. First, if the software project is large enough, it can often be logically split into multiple functionally independent assets. As long as each distinct modular asset costs under $20,000 and serves a separate standalone business purpose, they can each individually qualify.
Ah, I see. So if the total build is $30,000, but you modularize it so that the standalone client portal is $15,000, and the entirely separate inventory integration is another $15,000, you can potentially claim both.
Precisely. The legislation looks at the cost of the individual depreciating asset.
Okay, that's a huge loophole. Well, strategy, not a loophole.
Right. Alternatively, if the development requires solving novel technical challenges for your specific industry, the project might qualify for the R&D tax incentive, which is a highly lucrative 43.5% refundable tax offset.
Oh, that's significant.
Or, from a project management perspective, you can look at stage delivery. Phase 1, the core engine, is delivered and operational before 30 June 2026 to capture the IAWO, and Phase 2, the nice-to-have features, is delivered in the next financial year.
Makes sense.
The broader point here is that hitting the cap does not mean you abandon the strategy. It just means you plan smarter and lean on the experts.
Which brings us back to the core reality of this exact moment in time. For you, the Australian business owners and executives listening, this EOFY 2026 deadline represents the final, undisputed opportunity to claim up to $20,000 as an immediate dollar-for-dollar deduction for Bespoke technology.
It really is the end of an era.
The window is rapidly closing, and the threshold is violently dropping to a mere $1,000. The financial economics of upgrading your business operations will simply never look this good again.
It truly is the ultimate financial catalyst to finally pull the trigger and solve the operational friction your team has been complaining about for years.
So, what is the actionable next step? You need to stop buying office chairs and engage the experts who actually build these assets. C9 is Australia's leading custom software apps, integration, and database developer company.
Don't wait until June to figure this out.
Exactly. Do not let this historic deadline pass you by because you thought custom software was out of reach. You need to book a free discovery call with them today to scope out your exact project and assess your IAWO eligibility before that strict mid-May cutoff we discussed.
Right.
You can find their portfolio and book directly with their team at their website www.c9.com.au. That's www.decu.doa, c9.do.com/.go.
And please, if you found the insights in this deep dive valuable, hit that follow button on your player.
Yes, definitely.
More importantly, share this specific knowledge with other business owners, partners, and executives in your network. This is the exact kind of critical, time-sensitive financial information that can legitimately alter the growth trajectory of a business. And as the data shows, so many are still entirely unaware of it.
I completely agree. Drop the link in your Slack channels or, send it to your business partners this afternoon.
Okay.
Because I want to leave you with one final lingering thought to mull over.
Okay.
We started today by talking about that frantic EOFY trolley dash. And yes, this incredible $20,000 tax incentive for custom software expires forever at midnight on June 30th.
Yep.
But think about your daily operations. All that manual data entry your staff is doing, those disconnected systems failing to talk to each other, those exorbitant, ever-increasing SaaS subscription fees hitting your credit card every month.
They don't magically vanish.
No, none of those expire. They will still be sitting right there, waiting for you when you open your laptop on the morning of July 1st. The only question you have to answer today is this. Will you be paying to fix them right now with a massive government tax break, or will you be paying for them entirely out of your own pocket for the next 5 years?